everybody. Welcome back to the Raw and Real Estate Podcast. My name is Chay McGee. With me, as always, is my very dear friend, Belladona and today we're going to go over a little bit more deep dive on seller financing and what it can mean for you as a seller. We've got a lot to talk about today, so we're not going to spend a whole lot of time goofing around. We're going to get kind of right back into it. So, Belladonna, kick us off.
Okay. All right. So this is a subject that I have gotten really excited about, especially in this market. So I'm going to kick us off really quick with an article that was in today's Inman News. So they had interviewed, you'd think I'd remember his name, but I don't because we're live. So of course I don't remember his name, but it's the CEO of Redfin, who basically said that inventory levels are so low right now because these sub 4% mortgage rates are holding the entire market hostage, right? Because homeowners who would like to sell their existing home and go buy something nicer, bigger, whatever, are not willing to do so because it's too damn painful to have a 3% interest rate on your mortgage and turn around and cash it in for what, a 7% rate?
6.5%, 6 3/4. It's tough.
It's tough, especially if they're move up buyers. So the price of the home goes up and the mortgage interest rate can close to double. Man, it's painful. And so it's the perfect secret weapon to solve that is seller financing. So we came up with right before this podcast on a whiteboard, we came up with 10 killer reasons that benefit the home seller to offer seller finance as opposed to just accepting a traditional cash out kind of loan from the buyer, right?
Exactly. And we did this because we've both been inundated with different people looking to move up or buy another property, and they're just struggling with those rates, what's it's going to cost. And the traditional, I'll sell it, use it to buy down my other rate and get a bigger home for the same price, which is still an option, but it's not as much now with the rates being so much higher. So we got together and started digging into this to find out what we could offer in the way of education, showing you a better way that realistically most people don't know, because most agents don't know how to utilize and put together correctly to protect their clients and help them get it done.
Yeah. And no, and it's not even a criticism, because let's face it, most brokerages at the brokerage level don't really understand seller finance very well. And in a world where everybody could get a 3% interest rate and it was no big deal, there just wasn't a whole lot of demand or need for it, except in certain niche markets like investors. Right. So that's part of the reason I think this is such a timely episode, and I am so excited to dive in. So, okay, we're going to do 1 through 10, and we've got a 1.5 in there. So it's like 10 and a half reasons why it benefits you as a home owner to offer seller finance on your property. So you want to take it off with number 1?
Sure. I'll go with number 1 because it's one of everybody's favorite. Is you're just going to get a higher sales price. Most people can't do this or don't know how to do this. If you are offering seller financing and you know how to put it together correctly, you can ask for more because most people don't have the ability to do it. And you're setting yourself apart from all of your competitive homes on the market, and it can be huge for you. Realistically, it's about 10%, sometimes up to 20% more, but 10% is a fairly conservative, most of the time kind of number that people get above their competition and above what their house would normally sell for.
I totally agree. I think 10% it's almost a given. And if people say, well, like, why is it? How can you sell your home for more? And I think most people kind of understand this concept that that the average home buyer is more concerned about the monthly payment than the total sales price.
Mm-hmm.
And so as long as the monthly mortgage payment fits into their budget and the home fits their needs, they're more than happy to purchase that property. And with seller finance, we have a lot more tools at our disposal to help make a payment more affordable for a buyer. And actually, it's in, I'm cheating. I have a cheat sheet in front of me. We'll get to it. I think it's like number 4, where we're going to dive into why that is. But yeah, when you're offering those special terms as a homeowner, right, you get a higher sales price back in exchange for those killer terms.
Well, sure.
And
You might
then,
have buyers that had, a bankruptcy or something medical, or, a doctor that just got a job that doesn't have all that money saved up, but he's got a whole great income coming in that otherwise wouldn't be able to buy a house. If the opportunity is your home, that has a whole lot of value and translates to its higher sales price.
yeah.
One other thing, if you guys hear sound in the background, this is a working real estate brokerage. There's people out making money doing things. So if you hear stuff in the background, that's just the sound of money being made.
That's it, baby. That's it. That's deals going down, right? Because, hey, it's the Raw and Real Estate podcast. And we film every one of these episodes right out of our live real estate office. So if you hear background noise, pay it no mind. Okay, so number 1.5 on my list of why it's such a great advantage to home sellers to offer seller finances, it usually comes with a hefty down payment. That you get a down payment just like the bank does, but because you're not a bank, you're a homeowner, and you can't afford to take the same amount of risk that a bank does, what you get in exchange for that is typically a very large down payment. Now, everything is flexible, and that's going to be in point number 4. But traditionally, right, most of the time, homeowners can expect a down payment conservatively 10 to 25% of the asking price down. And that is your money to keep forever, right, Shay? Doesn't it?
And
No matter what happens.
that's a whole lot more than you'd get otherwise. I mean, let's say absolute conservative 10%. If you've got a $500,000 home, there's $50,000 of reasons why people are going to stick with it, and you've got that money right up front. And if there's a problem, that's yours. Realistically, we'll get into it a little bit later, but the house is yours. It gives you a great place of strength and a whole lot of money right up front for that down payment.
Right. And it covers all your upfront costs. And for most people, will also cover their down payment on their next home, which is often a concern, right? Because
Commissions are
great to
taken
sell.
care of, titles all taken care of. All those are done, so you don't have to get eaten alive with that. It all comes in that down payment, and you have a good amount left over.
Yeah, totally. And then you actually came up with point number 2.
Point number 2, I kind of touched on a little bit, is the increased pool of buyers. Going back to that doctor or someone that ran into, a hard time and had some medical debt and things like that, and are doing well building it, but their credit doesn't show that yet, but they have to have a home for, themselves, their family, whatever. You're offering something that most people don't. You are talking to a much broader range of people. There's a bigger pool of people with realistically more money to put down on a house. So the attraction to your home and all the people coming in that will want it, that are ultimately going to write you an offer and give you money, is much, much bigger. And the days on market goes down with that. You're offering things that they don't to more people. It's just a no-brainer for the most part.
Yeah, there's this massive pent up demand in the marketplace right now.
Well,
Of
especially
buyers.
with the market, we had kind of a rough market for a while. There's some things that happened. People got beat up that absolutely wasn't their fault, but they're kind of climbing out, and they need this type of an arrangement. And most of them, again, great, good income, good money down. A lot of people aren't giving them a chance. You can and absolutely benefit from that.
Yep. Absolutely. Um, and I'm laughing because we're streaming live. And so every time I say something dorky, I'm like, really? It's live. It's out there.
Yeah, but you're with me, so you look better in comparison. It's all right.
Yeah. So number 3 on our list, which is one of my favorites, faster closing time.
Absolutely. I mean, we've seen these as close as like 5, 6 days. A lot of them are 10. But I mean, with the traditional being anywhere, I mean, great lenders can do it in about 17, but there's this many great lenders and, this many lenders. But
Well, and stuff that happens, let's face it. Um, oh, okay, I'm debating if I want to say this or not. Maybe
send
I'm
it.
gonna chicken out, but okay, I will modify what I usually say to my clients in deference to all of our listeners out there. If you're going through regular bank underwriting and you don't feel utterly violated and feel like you need counseling after, they didn't do their job. And so
That's
it,
true.
it takes time sometimes to get through that underwriting process, which is why, the average close is 30 days. And then think of all the frickin' hoops that you have to jump through, right? Both the seller and the buyer, and the property even has to jump through a giant hoop called appraisal.
Mhm.
And while there's no reason why somebody cannot go get an appraisal with seller finance. The nice thing is you can do whatever the heck you want most time, but it's not a requirement. And if the home doesn't appraise, it actually doesn't matter much, because by the time they execute on the finish of that contract, appreciation will have caught up with sales price, which is another awesome reason sellers can actually sell their home for legitimately above market value and not have to worry about the home not appraising.
And the person that's demanding the documents to protect their interest is you. You're the boss. You're the bank. You're the one that gets to say what documents you need to see, what makes you comfortable, what you need to look at. It's in your hands. You're empowered to make those decisions, which is, it seems counterintuitive with, how many people traditionally with banks, but it's all in your hands to decide your level of risk versus reward.
Yeah. And then this is actually one of my favorites, is number 4, totally flexible terms. And you and the buyer, because you're not going to be dictating to each other, you're going to collaborate on this, but between the two parties, you are 100% in control of those terms. And so, like, when you're like, okay, what does that mean, terms? Well, how much down payment? How is it going to be delivered? Is it going to be delivered in one giant lump sum? What if you've got somebody that's got a certain percentage of the down payment now, but their circumstances, they can give you large chunks of down payment every single month over the next 6 months?
And you get
Something
more for it, but it takes a while.
Right. Or like we had touched on in our last episode, right? Where maybe part of the down payment is in cash and the other part of the down payment's a boat
Or jet ski or whatever. And when you're talking about timing, the time of the loan is a huge thing. It can be a 3-year until you need to pay it off and have a balloon or whatever. Or if it makes more sense, you can make it 40 years, you can make it 60 years, you could make it 99. It depends on what you wanted and what works best for you and the buyer. But there's a ton of flexibility and what works best in the negotiation for both of you, and it can be remarkably beneficial.
Totally. And we were just touching on, because we touched on earlier, like, one of the reasons you can offer a higher sales price is because you have control of terms. You can control, for instance, the amount of time that loan is amortized over. So with a bank, forget about it, man. If you're going Fannie Mae, Freddie Mac, it's going to be amortized. It's going to be a qualifying loan amortized over 30 years, and that's it. But with interest rates as high as it is, we have seen that is driving up monthly payment, that it's pricing some otherwise excellent buyers out of the market. Whereas with seller financing, we can keep the price high. We can even keep the interest rate so that it works for the buyer, but it's still profitable for the seller. We're going to touch on that later in another point. but we can amortize that monthly payment over 40 years instead of 30 years in order to get the monthly payment down at a place where it makes sense for the buyer. And then, like you said, we can place that balloon wherever we want. If people are like, what the hell's a balloon? Like, well, sure, a seller might be willing to offer 30 years seller finance, exactly like a bank, but most people want to be cashed out at some point during that process. So wherever you insert a balloon payment, basically that's the point at which the buyer does need to replace the seller financing with a refi, with traditional financing. And in this case, when does it come? Whenever the hell you want it to come. That didn't quite sound right, boy, live.
Moving on. We got this.
3 years, 5 years, 10 years, 18 years, 30 years. It doesn't matter. You guys work it out in a way that is equitable for all parties, ideally, right?
Because banks and credit unions and things can't touch that. Not that that's their fault by any means. They have underwriters, and the banks can only do certain things for risk. But you have the ability to, like Belladonna was saying, take 40 years at, say, a 5% interest rate, when right now things are going 6.5%, 6.75%, still make a good amount of money, which we'll get into a little bit later. But you have the flexibility to get that done, and it's just the agreement between you and the buyer.
Yeah. And we will actually be doing another whole episode where we're going to give top 10 benefits to the buyer of seller finance as well. We'll go into some of those in greater detail on that episode.
Absolutely.
Okay. Your favorite.
This one's one of my favorites, because I am a notorious fan of the Internal Revenue Service and taxation as a whole. It really makes me happy. Belladonna's laughing because she's heard me just absolutely lose my mind and have temper tantrums about it. Seller financing, potentially, I'm not a tax person, neither is Belladonna. Seek out a licensed tax professional. But typically, you as a seller won't be hit with capital gains on the gain of your home from what you bought it at to what you're selling at until the point where the loan is completed and it moves over to the ownership of the new party wholeheartedly. So you can put off your capital gains for 3 years, 5 years, 10 years. There might be the taxation problem where the tax man gets involved if it's like 40, 50 years down the road. But you can move that past and not take that capital gains right now if it doesn't make sense for you. And you can kind of push that down the road, which is a fantastic thing that, again, other traditional financing and cash won't allow for.
Yeah, totally. And this, again, we're not CPAs, nor do we play one on TV. So check with your CPA for the most recent laws and how it works. But you can also, one of the great things is you can spread, because normally capital gains is like a punch in the face, right? You have to pay them all. If you owe them, you got to pay them all right on the spot. Seller finance lets you spread it out over time. So if you're offering let's say you're offering 10-year seller finance, right? You're just paying a little bit of gain as you go on each of those payments, as opposed to that giant chunk up front. And then we're trying right now. We can't say for sure, but we have got a guest expert that we're hoping to come on the podcast. Yes. Should we sneak it out? David Kinney.
He's amazing. Absolutely.
Who really is the guru of seller finance, I think, in all of North America. And so we'll have him actually going into a little greater detail on some of those fine points. And then, of course, number 6, this is one that I think is kind of a no-brainer. It gives you an income stream. So not only do you have, because of the large down payment, the money that you need to put your down payment on the next home, maybe pay off some debts, pay commissions, pay closing costs, get all that stuff done. But now you have a monthly income stream that you didn't have before that helps offset maybe the cost of that next home or anything else that you have going on. And you have it locked in for however many years you're offering the seller finance for. I mean, let's face it, most people move up to a new home and all of their, or they do better and they buy a new home and it seems like all of their bills just rise with their income. Do you know what I mean? This gives you a chance to potentially move up to a new home or downsize, whatever you're doing, and actually grow your income through the sale of your home. And I think that's kind of cool.
I think that's awesome. I keep looking to the left to make sure that I'm not jumping ahead of one of our other points, but this is the point where I wanted to jump in with this. If you have that rate at 2.5%, 3%, even if you're seller financing at, let's say 5.5%, 6%, which is still an absolutely stellar deal, and someone would jump all over it to get into that type of financing, you're still making arbitrage on that and making a whole lot more money on the interest than you're paying out. On the last one we did, I kind of touched on a lady that was moving into an assisted living facility, and she didn't necessarily want to sell her home outright and just have the one check and have it eaten up. We structured it in the way so she was continuing to get that income payments so that she got that interest to help offset some of the time and the payments for those assisted living centers, because boy, they're not cheap. And it was amazing, and it helped her out in a way that we couldn't otherwise. So this can be great for something less traditional, type of scenarios like we're kind of going over.
Yeah, totally. And then these next ones kind of go together. They kind of cascade together. But one is, most folks don't realize how very safe seller financing can be. Now, obviously nothing is 100% safe. That's not what we're saying. But when it's set up correctly and the right contracts are used and the right protections are put in place for all parties, seller financing can be an incredibly safe investment strategy for anyone who simply wants a good return on their money that's safer and more stable than the stock market, with far, far, far higher returns than your other quote unquote safe types of investment strategies like, T-bills or whatever. And as a matter of fact, very often seller financing will outperform even your higher risk kind of stock market investments. And it's backed by real property. I mean, if something goes wrong and you have to take that home back, Shay, they don't give that. What do they do with the down payment?
You keep it.
You keep it. Yours. It's yours to keep. And now you get the house back.
And you get the house back.
And people are like, well, what if it's beat up? Well, I'm sure it's still worth a heck of a lot more than nothing, which is what you get if your stocks crash and you wake up one day and you're like, they went up in smoke.
And there are other protections with that, just like traditional financing, to protect the physical condition of your home as well.
Yes.
Like we said, it's all on you how you want to protect yourself. And there's any number of ways. So yeah, that can happen, but that can happen for a bank as well. There's protections that we can put in there. The biggest way to protect yourself is to have the right team. I mean, you're definitely going to want to have an attorney that knows what they're doing. You're going to want to have a title person that really knows what they're doing, on top of an agent that knows what they're doing. The right team will help you move forward with the proper protections, and you won't have to worry about. I think the interest or the stock market was down, was it 17% last year as a whole, 22%, something awful. Real estate in Utah was still up 17%. So, I mean, that's a given anyway. Plus, if you get interest and arbitrage on that, I mean, you can't print your own money. You're going to go to prison. But shy of that and selling illicit materials, this is a really good move.
Super, super good move. And I'm keeping track. Like I said, I've got my cheat sheet. And then this is kind of what we were just talking about. It's the perfect storm right now. I mean, one of the massive benefits of seller finance to the seller is there has never been a better time, probably in the history of banking in the US, for a homeowner to be able to offer seller financing and profit massively without taking advantage of a buyer. Because nobody's talking about like, let's just rake buyers over the coals. I mean, they're getting enough of that right now.
Right.
But with the historically never been offered before, as far as I know, in the history of the US, low interest rates that thousands and thousands and thousands of home sellers are sitting on, right? To be able to offer to be able to have the ability to mark up that rate and make a tremendous amount of money on the sale while still being able to offer something that's fair and equitable to the buyer. And there's a lot of ways that you can do that. I mean, you can actually just offer the buyer a killer rate because you're still making a good profit. But, there's nothing wrong. There's nothing at all wrong with matching whatever the current rates are today, because at today's current rates, they can't buy for whatever reason, but they could give you today's current rates. You have a huge markup and they can buy. And they're thrilled and they can afford more, like we said, because you can play with your terms. And so there's, I think, inventory shortages, sky high prices, sky high rates with homeowners with low rates. Never, ever, not even in the 80s, never been a better time.
And a very low inventory. Did you say low inventory? Did I just have like
but let's say it again.
Dream?
Like it's like freaking, it's like when you get those sick, weird once in a blue moon negative low tides, if you've ever lived by the beach, where it's so low.
And it's rough out there. It really is for buyers. There's not much out there. But again, all these people with all that equity, with really low interest rates, that can put their home on, differentiate themselves from all their competitors, make money on the difference between their rate and another rate, essentially buying down. No, that's the next point. Belladonna, I'll leave that to you. That's the next point. But there's a lot of reasons to do that.
Yes. Okay. So the one of the pieces I think is awesome. And again, it kind of goes with one of our earlier points of having that income stream. There are a lot of people that are afraid of being landlords, or they're tired of being landlords, one or the other. And seller financing gives you all of the upsides and pretty much none of the very, very few of the downsides of being a landlord, right? You get those rates. Oh, that's hilarious. Somebody's trying to come in the podcast room. Get out. We're doing a podcast.
Get out. You're good,
so
man.
You've got those, that totally, I distracted myself. Okay. So you've got all the benefits of having that income stream, but you're not a landlord. These folks own the home. They are the property owners. They know this. They treat it like their own home. So what's that mean? No midnight calls that the water heater blew out. No calls on a weekend that the toilet backed up. None of it. It's their home. So one, you're not getting the headaches of having to do maintenance and all that kind of stuff. And you don't have the expense because it is the new homeowners, the buyers, that are covering the cost of all that maintenance.
And they want to take care of the home because they have that pride of home ownership. It's not like a rental. They want it to be nice. They want to do great things with it. So, I mean, the chances of them taking great care of the house, paying you making that money and not having those headaches all boils down to what could be an essentially, like you said, perfect storm to help you get it done versus traditional methods.
Yeah. And let's face it, a homeowner that just dumped 10 or 20%. I mean, seriously, we're talking, let's just say they put $50,000, $100,000 of their hard-earned money that they will not ever get back if they default.
Yeah. They're not parking their Harleys on the front room.
Probably not. Right. Or if they are, it's their damn front room and they get to keep it, oil stains and all.
Their carpet. Yeah.
And so that's one of the awesome ones. And then number 10, okay, it's a flip. I think this actually might be one of my favorite points. Why don't we let you take this one?
Okay. What we can do with this is there's a lot of people, like we talked about at the very beginning of this, that they have a house, they want to do a move up house, but they're kind of terrified because they've got this 3% rate. Now we're looking at, 6.25%, 6.75%, something in there. I'm like, wow, with the higher price and this, higher interest rate, I'm going to get smoked. I can't do this. It's going to negatively affect my lifestyle. Doing this if you sell your home utilizing seller financing, you can make that difference, like we talked about a few times, between the interest rate you're paying, the interest rate you're getting from that, and essentially move that over and wipe out that higher interest rate because you're making that on the seller financing that you have. So you're not getting murdered. You're actually doing that arbitrage on the first to basically wipe out the difference on the interest rate with the second one.
Yeah, that's it. And if and when we get David Kinney on, he has got the most brilliant spreadsheet that calculates it instantly, where he shows that the average home seller out there could have what amounts to an effective interest rate on the new home less than on the home they're selling. He showed me one example of a deal that he did not too long ago where the effective interest rate for the home seller on the home that they turned around and purchased was 1.9% interest.
And we never got there that I'm aware of.
That never. So, I mean, it just cancels out the pain of those high rates. Mm-hmm. And so I'm like, and here's the thing that I really believe: once agents, but especially homeowners, start to see the massive benefit to them of being the bank, they're going to be like, why the hell haven't we been doing this all along? If I'd have known, I'd have sold all my homes this way, right?
Absolutely. And again, we're doing great on time. I thought this was going to take us way longer.
I know we actually went really fast. I think we were afraid that we were going to go over time. So we kind of like powered through them, man.
If you know either of us or both of us, you know that we could talk for hours on end about almost anything. But having said that, the best thing to do if you're interested, we're going to bring on, hopefully, David Kinney, and he has taught both of us about seller financing. Belladonna and I have used this on residential and some commercial and different things like that, but he taught and still teaches us how to do this at a high level. He is an absolute dynamo with knowing how to work these systems and customize them for the need. And we can't wait to have him on there. But one of the best things you can do is get the right team again. Make sure you've got the right agent. Feel free to contact Belladonna. Feel free to contact myself. Feel free to contact both of us. I don't think we've ever worked on something as a team on a deal, but that'd be cool too.
Which is really funny when you think about it, because we've worked together for a really long time. And then, it really kind of happened unintentionally, but we're doing a seller finance series. We'll also talk about, okay, how do you mitigate risk in a seller finance deal? And what happens when the worst happens and you have to take that property back? We'll walk everybody through it.
Yeah, we're not going to gloss over the bad. We're going to tell you the good and the bad and the worst of it so that you can protect yourself at the end of the day so that doesn't happen. Protecting against the worst, hoping for the best, will help you try and structure that to give you that opportunity. Absolutely.
All right. I'm excited, man. We got some fun episodes coming up.
Agreed. This has been wonderful. Guys, thank you for joining us. Thank you for watching us. Please let us know what you'd like us to dig into more. We're going to do more. Our next one is going to be more seller financing as it benefits the buyer. Yep. And we'll hopefully bring on David Kinney and
Jax Petty,
who is a shark, but like in the greatest sense.
Yes.
He's awesome. And we're going to bring on other people that we think is going to be truly beneficial for you and what you're looking to do. So let us know what you want and what you need, what would be helpful, and holler out at us at any time.
Okay, right on. And if you have like what your big takeaways were from this episode, drop them in the comments below. I'm pointing down like there's a video under me, Please. But you know what I'm saying? This is streaming live to all of our channels. So wherever you happen to be catching this podcast, let us know what you think. Drop your comments and questions below, and we will see you guys on the flip side.
See you guys.